Hello, everybody. Welcome to the Like a Tortoise channel. I'm recording this on a Friday, March the 6th. Thank you so much for watching me today, and I'm so glad that you guys are here. And happy Friday to all of you. Hopefully, you are all getting ready um, for the weekend ahead with lots of plans to spend some decent time with your families. And of course, I hope you all have an amazing weekend ahead. Okay. And so today I want to tell you about one stock that I would be selling like there's no tomorrow if that stock was to be found in my portfolio. It's not because it doesn't meet my criteria for a margin of safety. It also doesn't mean it doesn't meet my meaning criteria because I can't say that I really like the CEO. But we will talk more about that company as we move along this video. Before I do that, let me tell you that feedback like this they really make my days. And you can see right here that this was feedback provided by one of our current clients. Hey man, thanks so much for the session today. Really awesome as always, and especially today it's all really falling in place regarding the holistic methods that you teach. Looking forward to receiving the materials. So yes, thank you so much. And just this makes my day. And if you are passionate about your job, whatever it is that you are doing, then what happens is these days don't really feel like work. Okay, that's what I want to say. And I'm really passionate about coaching and about watching others thriving in the stock market. That's the only thing that I do. That's one of the only things I believe I'm really good at because of the experience that I've built over time, and by reading and investing a lot in my education as well. So as you guys thrive, I will thrive in the other way around. It's like a tortoise every single day. Right, guys? So spoilers alert, this is the company that I wanted to tell you about, and that is Palantir. Okay, this video will probably cause will probably backfire, but anyway, I'm very outspoken. I like to tell you exactly how I'm thinking about things. In my world, paying almost 230 times earnings is almost unheard of. I mean, it's certainly it's been this was these were the sort of valuations that you would see at the peak of the tech bubble, and then we know what happened with many companies, whether they were good or not. Now, I'm not calling the top for the market. I'm certainly not calling the top for Palantir. What I am saying is that if we really filter companies through a like a tortoise lens, this company would never be in one of our portfolios. Okay, so for those of you who are new to the channel, welcome. And if you enjoy, please smash the like button because it really helps the channel to grow. And it will also incentivize us to put out more valuable content like this video. And you can see that the PE of Palantir currently sits at 225, give or take. What this means, everybody, the PE is like the payback time period. Okay, so if earnings stay flat, if they don't grow or decline, they just stay flat, it will take you 225 years to break even if you bought the stock today. In fact, we always think as business owners, so we never invest in a company without thinking, how long will it take me to get my money out of the business from earnings or free cash flow? In this case, it will take you 225 years to get your money out of the company from current earnings, which is absolutely insane. To give you some perspective, the maximum I ever paid for a company was 17 times earnings. Okay, so we don't buy the shiny objects that everybody knows they are great, right? Palantir is, for example, is one of the companies that are one of the beloved companies in the market these days. They are at the front of AI, and so everybody recognizes they are a great company and they are priced accordingly. But we tortoises are looking for disconnects between price and value, not the shiny objects. That what happens with these companies is if they only miss by a penny, right? The stock is not going to come back down 5%, right? It's going to crash 30% in one day. And that's, even if they do go on to deliver good expectations, to deliver good earnings, but if the guidance misses exuberant expectations by a penny, that that alone will cause the stock to come under pressure. And what we saw is they reported earnings on February. When did they report? I think it was on February the 2nd, something like that, or February the 7th. And sure enough, even though they provided great earnings, that is, of course, that always in hindsight, the market is looking for the future, is looking into the future. And because guidance was not as strong as the market was expecting, that was enough for the company to actually pull back substantially. And right now, I think Palantir is I think they are probably 40% of the all-time highs. So yeah. But let's talk about this company for those of you guys who are not aware of this company. They engage in the business of building and deploying software platforms that serve as the central operating system for its customers. And what we can also see is that the company IPO'd on 2020. So we don't have our ideal 10-year track record. And what this tells me is that maybe the business model, in fact, not maybe, I know this for a fact, this company doesn't have a long enough track record, which means it hasn't lived through different business cycles. And I want to see exactly how a company behaves during recessions, and during bull markets as well. It's nice to have that, right? We want resilient companies. And that's why I typically like to invest in well-established businesses that have nothing to prove because they have been around for many, many years, right? So 2020, this will exclude this company from my investable universe right off the bat. Okay, that's it. I don't I think, yeah, 10 years worth of data is what I'm after. Some of you guys suggested I analyze companies with 80 years, with an 8-9 year track record. I can always delve deeper into their fundamentals, but I wouldn't feel comfortable investing in one of those companies, okay? And especially not at these prices. But let's have a look at the financials and see exactly what we are dealing with right here. Let me minimize this. What you can see is that total revenue is going up at about 33% since 2018. So this is exploding, which is awesome to see. If we zoom in on the financials, you can see that look at this consistency right here in revenue growth. Amazing, right? And it's actually, it feels like they are really picking up steam here. So revenues are growing even faster. If I zoom in on this now, yes, they are. Look at that. Since September 2024, revenues have exploded they've compounded by almost 70%, which is staggering. Okay, so yes, that's what it is. What about earnings? This is one of the problems, right? I mean, come on. I mean, right? I mean, look at that. They only turned the corner to profitability recently. That was in September 2023. Will I invest in a company with only just a few years of profitability? No. To me, that makes for a risky investment. So again, I would exclude that, but still, it's positive to see that we are going up, right? And so, yeah, this is definitely a positive. Now, look at another red flag. This company, since 2020, has diluted existing shareholders by about 56%. I never invested in a company that is diluting existing shareholders. I understand some dilution, especially when the company is just, for example, a startup, right? There are many ways a company can borrow money. So they can issue new shares, or they can go to the bank and take out loans. But many of them do a blend of both. But you can see that Palantir has diluted existing shareholders by 56% since 2020. Now, granted, right, revenues have compounded by a lot as well, but that is just too much dilution, ladies and gentlemen. I don't like to see that, okay? And that's why Stock and Lock flags the management with they only give management a 2.8 score out of 5 because of share-based compensation. You can see that share-based compensation as a percentage of operating cash flow sits at 32%, which is staggering. Okay, I like to see this under 10% to give you some context. I certainly don't like to see this. This is just too high. And anyway, it goes to show that the management is too busy paying themselves first. Okay, and I don't think they are on the side of shareholders. And this is one of the reasons why I would stay away from this company. All right, it works well and until as long as they continue to grow earnings and revenues at attractive rates. But in my opinion, this is just unsustainable. I don't like to see that. And I think they should be doing a lot more cash incentives. Okay. All the other things, all the other sectors, namely profitability, growth, are all at five or are all at or near five score, which is very, very good. Same thing with analysts' projections going forward. The valuation, of course, is at nosebleed levels. That's why they have a 1.25 score out of 5. But I don't really pay attention to valuation. Let me explain. I'm not sure if stock and lock decreases the overall score because of valuation. That's what I want to say. But if they do that, that's not something that I agree with, because a company can be fabulous. They should only give the company an overall score based on the fundamentals of the company, based on how high quality the company is or low quality. But and so the valuation should take a completely shouldn't be factored into this overall quality score, if you understand what I'm saying. Right. So in addition, let's have a look at what insiders are doing. You can see that insider ownership remains high, right, at almost 4%. I like to see that. But if I go to insider transactions, I see a wave of selling. Looks like insiders completely agree with me, and they agree that this stock is at egregious levels. Sure enough, look at this wave of selling. There are many reasons why insiders would sell, but only one reason why they would buy. And for those of you who are not aware, one of the best investors in the world, certainly in the private sector, that is Peter Thiel, and he is selling this stock like crazy. In fact, I think he is one of the founders, and he has been selling like there's no tomorrow. It's unbelievable. And so is the CEO, of course, and so are executives. And look at that. This thing goes on for several months, on just several months, 7 months of selling. And I was listening to another guy the other day, and it's incredible how they try to build a narrative to justify the stock valuation, right? Just to justify paying a high multiple at today's prices. And they will go to great lengths to do that. And it's like they are not hearing themselves, at least in my opinion. But anyway, so looking at this from a like a tortoise lens, I mean, I would stay. If this company was in my portfolio, I would be selling it right now. And even though it's not in my portfolio, it's not a company that I would invest based on current prices. That's what I'm saying. Okay, so what else did I want to share with you guys? Let's also have a look at the balance sheet, because according to Stock and Lock, they score very high on profitability, and it makes sense. If I show you this right here, you can see, if we go here to financials, right? Let me show you this. So let's go here to statistics. Take a look at this. On the balance sheet, you can see that they have a net cash position of about 7 billion. In other words, they can use the cash and cash equivalents to pay down all of their total debt, which is very good. So this is a pristine balance sheet, as you guys can see. Look at the financial position of the company. They have, look, right? They have almost no debt relative to what the free cash flows of the business and the operating income are. I like to see this a lot. In addition, current ratio is also very high. They generate a ton of cash. Let's put it that way. But you can also see, right, why the stock is so expensive. Look at this. Analysts forecast for the next 5 years for earnings per share and revenues. They are projecting earnings per share to grow almost at 60% per year. in revenue of about 49.30% over the next 5 years, which is staggering. All right. And you can say, oh, Ed, so if the stock today is priced, for example, at if I show you this right here, right? Let's go here to, no, it's still in statistics tab. You can see that the PEG ratio right now is actually at 2.58. But even the PEG ratio, I see a lot of people overemphasizing the PEG ratio. But what they fail to realize is that just because the PEG ratio is under 1, that doesn't mean you are necessarily trading, you are necessarily buying with a margin of safety, because the PEG ratio shows you the valuation of the company relative to its growth projections. But if the PE, for example, is at 50, okay, if the PE is at 50, which is egregious, but if analysts are forecasting 60% earnings per share growth over the next 5 years, right? And in fact, if growth is projected to come in at 60% next year, then the PEG ratio, of course, will be under 1. But does that mean the company is cheap? No. Does that mean you have a margin of safety built into your model? Absolutely not. Not in my world. Okay, so just remember that, because this is important. But still, even at these exuberant valuations and exuberant forecasts, the PEG ratio is still very, very high. So yeah, I mean, damn it, I would have sold this so. I mean, yeah, I would never let one of my companies reach these levels. Some of you, for example, asked me the other day, oh, wait, but so when would you sell a company, right? A high quality business? Would you hold on to it forever? The answer is no. That's part of the reason why I didn't sell Ulta Beauty, right? For those of you who have been following the channel for a while, you know that I bought Ulta Beauty around these levels, so around $322 a share, which is you would have to go back to 2017 to see to the last time the company to see the company. Well, you would have to go back to 2017 to see to see the company back at those prices. But the company, so they already surpassed my intrinsic value calculations, so my intrinsic value level. But the reason I haven't sold is because, number one, this is a very high quality company. And as Peter Lynch once said, selling your winners is like cutting your flowers, right? So selling your winners and buying in holding on to your losers is like it's like cutting your flowers and watering out the weeds. All right, we don't want to be doing that. However, if at one point Ulta Beauty's valuation levels become egregious, then of course I will sell the stock. But that hasn't materialized yet, and so I'm holding on to my dear shares, because remember, it's a high quality company. And high quality companies deserve to be trading at a premium. The problem is when the valuation goes way out of line with fundamentals, and that's when you really should consider selling. Okay, and you can see that analysts still rate this with a buy, but that doesn't really surprise me, because when a company is doing well, they are always constructive. When the company is doing poorly, they are all pessimistic. Opinion follows trend, ladies and gentlemen. Opinion follows trend. That's exactly what we are seeing with Ulta Beauty. They rated with a buy, okay, despite the valuation levels, because they remain very constructive, because the stock has been on an absolute tear. Opinion follows trend. Okay, also going back to capital allocation metrics like returns on equity, like I said, these are expanding for sure, because the company turned the corner to profitability recently. So yeah, all of this is going up, as you can see. It's nice to see that, okay? Right, and in addition, last but not least, I want to show you the margins. And you can see that margins are going up, going bananas, as you can see. So it's nice to see that now that the company has turned the corner to profitability, profitability is actually exploding and the business is gaining a lot of operating leverage. So what this means is that the operating income is growing much faster than the operating expenses, and then you see stuff like that, okay? Awesome, everybody. So remember, if you like this video, Just make sure you smash the like button. Once again, it really helps the channel. Thank you so much for being for being awesome viewers and for sharing all of your comments. I read everything and I always reply to each and every single one of you, and I will continue to do so. Thank you so much. Enjoy the rest of the day. Have an amazing weekend ahead, and be a tortoise always.